Ladies and gentlemen, it's 6 o'clock in London, it's 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco and Silicon Valley, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world. My name is Patrick L. Young, and this is my second LinkedIn live stream coming to you over the interweb from Valletta in sunny Malta in the middle of the Mediterranean. IPO Video Live is the new live stream, in Patrick's opinion, that's me, where I delve into matters of moment in the financial and business world and introduce today my first guest. Following in the footsteps of last week's discussion about flukenomics, we're streaming to the world via LinkedIn and YouTube with episode 2, welcoming global markets expert Christopher Messina, who works across the frontiers of AI fintech as CEO of Crowdfill, holds advisory roles in crypto for prime brokers, and sits on the board of a major international nickel exploration and mining company. There you go, ladies and gentlemen, everything from the totally virtual to the totally physical. Christopher brings decades of deep dive experience across finance and investing to this second IPO video show. We'll be joining Christopher in just a moment at home in Melbourne, Florida. But first, thank you, everybody. You sent through a huge number of comments and suggestions for IPO Live, and we really appreciate all of the feedback during the course of the past week since our first beta edition. It's great to already have a stream of exciting guests coming together in the pipeline for forthcoming weeks, and we're going to be discussing all manners of business, markets, and investment. Meanwhile, today, if you have a question or comment, type it in the sidebar or wherever that bar appears on your browser, and we're going to get back to you forthwith. Comments, suggestions, questions, we welcome them at all points in time. Now, looking back on the week that's just been, well, my number of the week is 52.5%. That is the pretty earth-shattering operating margin of MSCI, a doyen of the market infrastructure business who produced some scintillating numbers already this week. As you may know, I produce the daily Bourse business newsletter Exchange Invest, and we've been having a very, very exciting season of parish results. Every one of them has been scintillating so far, well, until the CME group today, which was a bit disappointing. But at 52.5%, that MSCI operating number is quite sensational. Another interesting number this week in the macro economy. Hong Kong's economy contracted 9% in Q2, while Singapore, their Q2 retrenchments have been spiking. They've already surpassed the levels of SARS, that epidemic of the early 2000s, which barely touched Europe and America, because, of course, in those days, global travel out of China was so much less so. Anyway, in SARS excess, Singapore have recorded 6,700 layoffs in Q2, but the numbers are expected to yet worsen as subsidies to help firms cope with the coronavirus expire, according to analysts. Meanwhile, over in Washington, amongst other capitals of the world, work is continuing on that pulley mechanism required to comply with health and safety laws, while ultimately the government endeavours to propel the kitchen sink laden with cash and fiscal incentives into a potentially moribund economy. That, of course, leads me to a potentially worrying piece of news, which comes from, well, actually a nation which more or less borders this one on the other side of the Mediterranean. Beirut, the Phoenician Empire, of course, a trading partner of Malta going back, good grief, 6,000 years before Christ, if not earlier. Somewhat rather dysfunctional government, tragically, in Lebanon these days. It's become the first country in the Middle East and North Africa in this crisis to see hyperinflation. Its inflation rate has exceeded 50%. That's not a 52.5% gross operating margin, such as MSCI. No, just 50% inflation for goods in the course of the last 30 consecutive days. Those statistics come from none other than guru of the topic, Professor Steve Hanke. Does the spectre of hyperinflation loom over us all with all of this money coming out of the kitchen sink and quantitative easing? I wonder, ladies and gentlemen. Meanwhile, in the UK, 25% of UK financial professionals, members of the Chartered Institute of Securities Investment, 25% of the membership don't want to return to the office. I wonder How long will they have jobs if they don't return to the office? Or indeed, does that mark them out as the people who are ideal fodder for being in the next wave of retrenchments, similar to Singapore? Speaking of other fascinating numbers, I read recently a Bank of America survey noting that 98% of investors reckon the stock market is the most overvalued since the dot-com bubble. And that survey took place about 10% ago in stock market value terms because, of course, things have been ratcheting up so quickly. But at the same time, cash on hand, even a few weeks ago, had dropped by 5.7% to 4.6%, which also suggests a lot of folk are reckoning the greater fool will take that stock off them. At least it proves one thing. With this disparity of often contradictory opinion, there is a market out there in stocks to be debated the old-fashioned way, with hard cash and indeed on live streams such as this, I suppose. And I suspect there will be rather a lot of margin in the way for intermediaries as they try to make money from, well, even the free brokerage business. And of course, that brings us to the general growth of retail trading because, well, first of all, numbers that I think I've been talking about before, losses rising for amateur leverage traders have been pretty spectacular during the pandemic. CMC Markets in the UK warning in January that 70.5% of their retail investors were losing money. Now that's risen to 79% during the process of furlough, lockdown, work from home. The loss rate at similar leverage brokerage, actually one of the oldest in the business, IG Group, has risen from 68 to 76%. And indeed at plus 500, they take the biscuit. Their rates have risen from 76.4% to 80.5%. Plus 500 alone, they've attracted 196,000 new customers, actually precisely, I do believe it was, no, not 196,000, but 198,176 customers in the 6 months to the end of June, compared to 47,540 people a year earlier. So clearly, lockdown is making a lot of people a lot more speculative. Equally, CMC have said their trading during the last quarter was double the level in 2019. We've seen from the big legacy brokers onto the exchanges, such as Interactive Brokers and Charles Schwab, stunning, excellent numbers for both the first and second quarter of this year. However, brace yourself, ladies and gentlemen, here's the statistic of them all. China, in the course of the last week, since the first LinkedIn live stream that we enjoyed discussing Flukenomics, over in China, they reported a growth in investor numbers at the domestic stock exchanges of over 1.55 million people. In other words, that's almost actually getting on for 4 times the population of Malta, or something like 20 to 30 times the total number of domestic retail investors in a stock market like Romania. Meanwhile, China is expanding its global taxation remit, which is quite interesting and potentially has big ramifications on Chinese folks working overseas, particularly in Hong Kong. Initially, China was not terribly interested in enforcing this law, but now it's decided, in line with, indeed, the United States of America and the Philippines, because it has it on the statute books, it can go forward and tax its citizens the world over, no matter where they're working. Now, that makes a big difference if you're working in somewhere like very high cost, high maintenance Hong Kong, a buzzing, wondrous economy, but with a top tax rate of 15%. Whereas, of course, the Chinese taxes top at 45%. Quite a few Chinese nationals are undoubtedly deeply concerned about the arbitrage between the extra cost of property in Hong Kong and the relative salary disparity if they go back to Shanghai, Beijing, or wherever. Of course, on the other hand, some residents of the United States of America, for instance, perhaps in California and parts of the eastern seaboard, may wish to muse on how their income tax rates, federal plus state, are potentially higher than communist China. That may, of course, be driving a crime wave, and that's our final and fascinating statistic of the week. According to a recent survey, 1 in 5 Americans have been the victims of porch piracy since the start of COVID-19. All those Amazon parcels being dropped off, deliveries across the world, they have encountered problems with them being stolen from their very own front yard. My name is Patrick L. Young, and apart from being a professional derivatives trader as well as running a stock exchange a while back, I've been a lifelong entrepreneur. And indeed, I've enjoyed a varied entrepreneurial career with online ventures on this dear old interweb thing dating back to 1994. During some of those early escapades, I was fortunate enough to meet fellow pioneers in the internet era. And one of the many fine folks I met virtually through the ether was the inescapably charismatic Christopher Messina, whose family, like so many in the great US of A, have roots in the islands of the Mediterranean, in this case, Sicily, just 50, 60 miles north of where I am speaking to you today. So, Christopher Messina coming to us today from Melbourne. Fortunately, that's Melbourne, Florida. So unlike Melbourne, Victoria, you're not in lockdown and you're happy to talk to us this Wednesday lunchtime as it is in Florida. Christopher, greetings. How are you today?
Doing great. And I'm delighted to be here from the great state of Florida and not in many of our other fine states in the Union where things are a little bit more oppressive these days.
Well, Christopher, it's a delight to see you. It's wonderful that you're coming to us from one of the states, which I have to say is not going to be vying with Communist China in the short term for its state taxation, certainly. But we first met, good grief, on the internet, 25 years ago, something like that, when I was doing an online magazine about the derivatives business and so on. Yep. Tell us a bit about what you were up to at that time and how you first came to interact with the interweb.
I tell you, it's fascinating that time has flown by that quickly. I'm a native New Yorker, and I had been living back and forth between North Africa and South Africa for a number of years in industrial sales, and moved back to New York and went to work at Goldman, which seemed to be a wise thing at the time, and just dove in on a bunch of things that later became fintech. And amazingly enough, as I was began my career in Goldman doing risk management and then moving into proprietary investments, I came across this guy on the web who was writing this newsletter about derivatives trading and how the floors were going to go virtual someday. And I remember a lot of the predictions you made back then, 1995, 96. We're going to have AR and VR helmets. We're all going to be interacting virtually. And a lot of that stuff is going to become environmental. I remember one thing you wrote about, we're actually going to have synthetic cigarette smoke to pour through your helmet if you'd like, so you can really get the feel of being back on the floor. So it's been quite a ride since then.
It's incredible, isn't it? Because actually, when you look at the fine art of prediction, you can get lots of macro things right and micro things wrong. I'm always reminded of, there's a brilliant British sci-fi series from the 1970s called UFO, about unidentified flying objects. And everybody was driving thermonuclear powered cars, because that was all the rave from the 1960s. They had amazing hairdos and they wore these weird materials on their bodies and so on. And then actually, the guy who was the boss of the World Space Agency or something, he used to walk out of his office and in front of them there would be a typing pool. So there would be like 10 women and they were all sitting there with typewriters. Nobody had bothered to think about the idea you'd have a screen in front of you. So yeah, some of the things can go wrong, such as that. The idea of the screen blowing smoke over you never quite came together. But on the other hand, there's still time. There's probably somebody out there looking to do that. Encourage crypto business somewhere around the world.
Exactly.
You talk to me a little bit about your interaction, because you're on the cusp of fintech, these days AI fintech and more, and we're going to get to that in a second. But as a whole, I think you're with me. Maybe the next, the interim time in the world economy is not looking terribly good, but I think we're both really convinced of one thing, which is the power of markets to manage to make things better.
Oh, amen. It's the only thing that's going to save us in this. And the one of the biggest and most fascinating things I've been watching is you can make some good predictions, and we all have, about where policy decisions lead to. And I think the biggest headache that a lot of policymakers around the world are trying to grapple with, right? And I think most of them are trying to do an honest, good job about it, leaving the insane, screaming politics aside. What is better, right? When this pandemic hit, what is better? Do you let it wash through the community and develop herd immunity and you protect those who are older and vulnerable? Or do you do what we did, which was some degree of, sharp economic contraction? I think we all come down on different sides of that. I came down hard on the side of, poor nations or sick nations. So, you're not going to impoverish your way to health. So we probably should have struck a better balance. I think we're getting there. But the thing that is going to make people, come out of this, a vibrant, free economy. One of the most terrifying things, I use that adjective wisely, that I've seen recently is the idea being tossed around the Fed that we're going to start to control the yield curve. Nothing can be more damaging. I mean, water finds its way around a rock, right? There's a reason why impoverished people will strap 40 pounds of cocaine to their backs and try to cross the Rio Grande in the middle of the night, because it's worth it, right? So the more we put things in the way of people making an honest living, the more distortions we're going to see, and the more policy that enables people to make free decisions and provide services and buy those services and goods they want, the faster we're all going to get out of this. I don't think that's contentious, but amazingly enough, in this environment, that statement is contentious. I wish it weren't.
And it's interesting because you hit upon something there for recent students of economics. You mentioned something that seems almost mythological now, the yield curve. Back in the day, I mean, people used to study economics, and sort of after you got demand and supply curves, pretty much the 7th or 8th diagram was this amazing thing that was going up like that. And a lot of people don't readily appreciate or understand the idea of the term value of money because they're used to the idea of zero interest rates. And I mean, talking about the retail trading boom, I think a lot of that is being driven by the fact that nobody's got any idea of what they can actually do with their money unless they essentially punt it straight into the stock market.
Oh, absolutely. And that's one of the major headaches. When you effectively create a tax on wealth, and not wealth in the, billionaire sense, but just wealth in general of households. Once you have a policy of inflation combined with an interest rate environment that's basically negative, you encourage all sorts of poor decisions, right? If we had sound money in various regimes around the world, we'd have sounder decisions. And sometimes you look back at these things, you think, wow, if only they had made a better decision 10 months ago. Well, you can't make decisions in the past. You can only make them today. So the leaders, I think, that are going to come out of this the best, both business leaders and public sector leaders, are those who take the hard decisions, right? I mean, Winston Churchill during the Blitz did not say, hide inside and eventually the Germans will go away, right? He said, we're going to fight them on the beaches. We're going to fight them in the streets. And so thankfully, we're not fighting anyone right now. But similarly, in an economic sense, you got to face reality. You have to face the reality of what we're looking at and let people make their own decisions. And until we get to that, until we stop having these kind of ham-fisted controls on top of policy and individual decisions, the distortions are just going to get worse.
And it's certainly a lot clearer message, the idea during wartime of how Churchill was portraying all of the things that had to be done compared to, say, the British government recently, where we really have had this mask, hokey cokey, you put it on, you take it off, you put it on, you take it off, who knows what you're supposed to be doing. And indeed, to our viewers in the UK, Laura Mercurio, hello, enjoy wine o'clock, and I hope you don't have to wear a mask and you manage to drink the wine quite freely at this point in time in the benighted COVID-19 era. Thank you also, Taryn Barron, for your kind comments. It's great to hear from you, ladies and gentlemen. Questions to Christopher, please. We're going to be talking about his very exciting AI fintech ventures, amongst other things, in just a couple of moments. But Christopher, tell us a little bit more about how your career developed through Goldman Sachs, because you're really a polyglot in financial markets, if I may say so.
Yeah, it's funny for those people who've ever done improv theater, and I didn't quite start out thinking that my career was going to be improv, but the core tenet of improv is that when you are a participant in the troupe and you are handed a line, you have to say yes to move the plot forward, right? It's not funny to say no. The moment of the movement of the developing story arc just dies, and I didn't realize this until later, but. I came from a very risk-seeking entrepreneurial family. So to me, never mind the glass is half empty. I mean, the glass is always completely full. You're just missing something. So whenever someone presented me with an opportunity to, would you like to jump in on this? Said yes, and there's no reason not to. I mean, I think there are really excellent professionals and colleagues who I respect greatly, who came out of their fourth year of university knowing this is what I'm going to do, right? They did 2 years in an analyst program at Morgan or Goldman or wherever. And they went back, got an MBA, and they went back and became an associate. And they've been a telecom investment banker their entire careers. And God bless, they've done phenomenal work. And they've created great value and jobs and wealth and all wonderful. But whenever someone asked me, especially in the early days of what became fintech, where there was no clear career path, right? And I think one of the bosses I had at Goldman actually said, "This is a risk. Would you like to jump in on this and work on it?" And that became BrokerTech, which became one of the largest bond trading platforms of all time, right? But there was no clear line of saying, if you do this for a year, it's going to advance your career in this division. But if you want to jump in and learn a lot more about market evolution and do real serious innovation, do that. So over the years, I've done that. And after the IPO, McKinsey poached me out to Silicon Valley. And I said, yes, went out. It was great. Spent a lot of time understanding the vast differences in approach between the Valley and Wall Street. Very, very quickly, one of the things that highlights to me the difference in the culture, and you can't argue with the economic results, the approach is different. I was asked to sit in a meeting. I literally landed in San Jose, and being a New Yorker, I thought I'd get a cab to their offices, right? But there were no cabs. I had to rent a car. So that took like 2 hours of my life. And I finally got there. I got there just in time for a meeting where there were a couple of VCs sitting there and these two kids, I'm imagining them wearing hoodies, but that's probably a reconstruction, who had this 8-page slide deck, and they were going to offer this great new service to Wall Street. And so I whipped through it. I listened to them, and everyone looked at me for my response. And so I tried to think of intelligent questions like, have you ever worked on Wall Street? No. Do you know anyone there? No. Have you ever been east of the Rockies? No. Where did you get this market sizing from? Well, they read it in the San Jose Mercury Times, whatever. And so I thought I'd stall for time and said, well, I tell you what, when I read the business plan, I'll come back to you with some thoughts. Everyone looked at me like I was completely insane. And someone finally spoke up and said, this is the business plan. I exploded. There was nothing in there about competition, about finances, right? I think I have this vision of a rainbow with a unicorn jumping over a pot of gold at the end of it. And I thought it was ridiculous. And the joke's on me because, that afternoon they walked across the street and Sequoia gave them $5 million. Now, I don't know if they succeeded or not, but it was just a very different approach to how you think about allocating capital.
Fascinating. Certainly when you compare it to how BrokerTech was so phenomenally well planned. I mean, BrokerTech, for those who don't remember, was a consortium of banks which came together to try and build the new face of essentially bond broking. It ended up being slightly sidelined, obviously, because of antitrust considerations between the banks, as I seem to recall further along the line. But therein, of course, it sowed the seeds for market access and TradeWeb, and indeed the basis of the business, BrokerTech, is still within CME Group to this day.
Yeah, no, and it's an excellent example of the arc of history, right? Had the main interdealer brokers, the voice brokers with whom BrokerTech was designed to compete, had they capitulated on the day of launch, had they capitulated and slashed rates to all of the, I think at that time, 16 member banks, BrokerTech would have died, right? Because it would have achieved its goal. It would have achieved cheaper brokerage. Luckily, they didn't. They fought on, and then BrokerTech did well. But it changed over time, and then it was bought by ICAP because, as you allude to, a slightly narrow vision of the Department of Justice about collusion. There was none, but the appearance is often as bad as the reality. Turned into a great utility, and Michael Spencer built a great business around that, and then spun out again later. So it's proved its viability and utility to the market. That sort of functionality. And so, I always look at that and a few other things that I was involved with in early to see what other things that were started at the same time failed to get any traction and why. And you learn as much from your competitors' errors as your own successes.
Well, also, it's very interesting looking at the actual technology because, first of all, the cost of technology build. I mean, you look at how much money went into something like BrokerTech, which was entirely commensurate with what it cost at the time, what you can manage to do these days for a fraction of the cost. I mean, good grief, the newsletter you're talking about, we spent $1 million on the website at one point in time, the entire business, the entire system, which now you can replicate on WordPress for about $1,000.
Yep. No, absolutely. And that is the hallmark, and that is what I had a chance to speak with one of my daughter's classes, to her high school class, and said, you're going to hear a lot of things, especially in political times, about capitalism and socialism. I said, all you need to know is, if you look at the objective truth, some of the poorest people in the world have luxuries that kings and queens didn't have 100 years ago. So the the beautiful part of a free market system is it takes luxuries and turns them into commonalities. And if you just let that go, it tends to work really well. Are there bumps along the road? Of course there are. But right now, yeah, I mean, creating a matching engine and creating the Crowdfill engine is significantly less expensive, both in time and intellectual power, than it was, because of so much development that has been done in the preceding 25 years about matching engines, connectivity, the relationship of hardware to the sorts of loads that are required by markets. All of that feeds a vast ecosystem, which has in turn affected markets far outside of the capital markets, right? eBay and all the rest of those, all those types of things run because it made sense to adopt these types of models to other parts of commerce.
Well, I mean, that's, going back to, actually, I was discussing this in the Flukenomics last week. I mean, that's one of the things that's the funniest thing and the most frustrating thing to listen to at a startup conference. There are all these people saying, oh, Airbnb, they don't actually own any hotel rooms. And at the same time, you've got eBay, they don't actually tend to own the goods that they're selling. And you've got Uber, don't own a single taxi cab. And it's like, yeah, because it's an exchange, duh. I mean, it may not be regulated in the same way as something like broker tech or the New York Stock Exchange or whatever, but it's essentially that same commercial model, which goes all the way back to the dear old ancient Phoenicians, 4,000, 5,000, 6,000 years before Christ. And I think that's a great comment from Romina Farrugia. Thank you very much. Talking about, it's the basic concept behind free trade. And actually, Chris, I want to get on to Crowdfill in just a second, but I have got a zinger of a question has come through from a member of the audience. Thank you very much. It's been posed anonymously. So that's either because they're one of your good friends or one of your worst enemies and they're trying to put you on the spot. They're asking, what that was around in the early days of fintech has not ultimately been fulfilled? Pick one thing if you can. I mean, the good grief, I think we could be here for hours just answering that question.
We could. I would say the thing that has proved most insanely, remarkably resilient is that it is harder to cash a physical commercial check cross-border today than it was when the Fuggers and the Medici were operating in medieval Europe. I mean, there is zero reason on earth that in an age of I can send you Bitcoin, I can send you cash on Venmo, you and I and businesses can transact instantaneously. The fact that major banks are still permitted by their customer base to say, yes, well, it will take me 7 days to issue that check. And when it lands in Australia, we're going to charge you to cash it. And it's going to take another 9 days. I mean, it's madness. So what I found most fascinating in looking at why that happens, the things that haven't taken off so well, is the flip side of those things that have. And so where there's a concentration of professional interest in making a system work better, right? There is a voluble constituency that is voting with their dollars to make a system work better, right? That's when those systems have worked really, really beautifully. When there is a distributed benefit to be had, that's a little harder to pull together. And arguably Silicon Valley has been better than Wall Street at pulling that together. The Robin Hoods and the like, all the retail trader knows is I'm trading for free. And in essence, you are, because your broker is selling your order flow to a bunch of market makers. And that's fine. You're not any worse off than you were. You're protected by Reg NMS. But the things that haven't worked would oddly seem to be the things that were most obvious in terms of smoothing flows. And a lot of the things around settlement and clearance and all of that. I mean, T+1, there were working groups on that I thankfully dodged joining in the 90s. That's still an issue in some settlement regimes, and often because there's a reason. There's some people benefiting from intraday float or 3-day float, right? So the longer-winded answer for anyone who asked that is go look for the underlying reasons, and cui bono, who is doing well by the system not working more efficiently.
So that brings us beautifully, elegantly. Thank you very much for that question, ladies and gentlemen. Send your questions in for Christopher. It's a great discussion we're having here about all aspects of markets. Let's move on to actually that business in AI and fintech, Crowdfill. You alluded to it earlier on. Now that's trying to shake up markets in a very interesting way.
It is, and like all innovation, right? I mean, as I tell interns and younger employees and students when I lecture, is that don't the business press is full of 2020 hindsight hagiographies, right? It was inevitable. Said genius against all odds, had 948 VC meetings, and now he's a billionaire. Yeah, and there were 700 others that had the same meetings and went and got a job, right? So what Crowdfill is so interesting about it is it is the logical extension of how markets should trade, right? And I can call it absolutely brilliant because I didn't invent it. My partners Roy Neff and Richard Himmelstein invented it. They brought me in to turn it into a business, operationalize the IP. And the great insight, and all great insights are obvious when you hear it. But the beauty of the insight is that you didn't see it first, and that's why it's so smart. So when you think about all the technology, and I love going back to the Phoenicians, until 100 years ago, or even 50 years ago, the only way one could trade a share of stock, a bond, a bale of cotton, whatever it was in serial, right? You have to trade one at a time. I'm writing on a piece of paper buy, you're writing on a piece of paper sell. That could have been clay tablets in Babylonia, whatever. You're doing it one at a time, and your ability to trade quickly is literally limited. The choke point is your ability to write as fast as you can and speak as fast as you can to your counterpart. And even then, as the oil traders in the NYMEX would have told you, 20 years ago, the price could vary wildly across the ring depending upon where you are in a fast-moving market, right? So because of that, because when we continue to build something, we continue to trade in a certain way, we often adopt the technological processes that existed, even though the conditions that required that approach no longer hold true. And what that means for Crowdfill is when I was part of this, right? When we set up broker tech, when all the exchanges went electronic, the central limit order book concept, no matter whether you trade in microseconds or you trade by appointment, is still one at a time. Well, but why? There's no requirement to do that. You've got supercomputers that do optimizations of thousands of factors for NASA in 5 minutes. You've got slower computers that do the same thing for 2 hours. So why on earth do we still trade things one at a time? And that was the brilliance of Crowdfill, is that in a world where if you look at factor trading and you look at factor indexes and you look at, I started this in 2004 after talking to Bill Fung for 4 hours, and wrote one of the first checks into alternative beta. The insight there was, if you're an investor paying 3 and 30 in a fund of funds product, but 90% of the time you can replicate those after fee and after tax returns with a 20 basis point swap based on 7 to 11 liquid factors. Why on earth am I buying the fund of funds product? And that became a behavioral finance issue. The answer was because the people writing the checks to the fund of funds businesses liked having cufflinks and corner offices and important titles like chief investment officer, whereas they get the same returns using an Excel sheet and working once a week. So for Crowdfill, what that means is if you are taking a view as a market maker, or you even have a view about biotech stocks in general, the bulk of returns in both long only and alternative funds often are 50 to 60% the beta of the market, another 30% of the beta of the sector in which you're trading, and the individual name that contributes to that return is often single-digit percentage points. So if that's true, and I want to make markets in biotech stocks of, say, a certain size and a certain average daily volume, I'm rationally indifferent to which names I'm buying and selling. And so Crowdfill enables people who have serious needs, like I am a trader who has to rebalance my portfolio manager's portfolio with these 8 names. I can't change those. That's what he wants or she wants. That person can come in the meet in a quiet, safe place with factor traders, liquidity providers who say, I'm willing to make markets in these names. I'm indifferent to the individual name. And because of that indifference and that abstraction one level up, there's a far higher chance of finding an optimized solution to all of those given needs at one time. That's the brilliant insight of Crowdfill.
Fascinating altogether. So therefore, the product is aimed at what sort of client base?
It's mainly, the core of it. So we're either going to launch it as an exchange or an ATS, either in partnership with others or ourselves. But as a marketplace, done correctly, it could be indifferent, right? You could be a retail trader on E-Trade or Ameritrade And so long as your order is still getting the same treatment at a Reg NMS, thinking about US rules, then you should be indifferent as to how it gets filled. Right now, if you're a retail trader at Ameritrade, for example, not picking on them, Schwab, anyone, your order flow is already being sold off to market makers. So it doesn't matter to you as long as you're getting better fills. The vast bulk of the users, of course, are institutional investors who have much larger positions to move. Right, TCA, transaction cost analysis, is a huge business because nothing is more frustrating to a portfolio management shop in general than giving up the alpha you worked so hard to identify and then giving it up in the trading execution. Right, so those folks have the most interest in making sure that they can execute smoothly at levels that make sense to them. Ironically, or I don't know if that's the right phrase, but most of the time when people build new systems, it tends to be heavily focused to one side or the other. Either the sell side is going to love it for X, or the buy side is going to love it for Y. For what Crowdfill is built, it's actually built from a market making perspective, and market makers like the idea because if you are trading 50 shorts and 70 longs at one time in one batch optimization, you have automatically reduced legging risk. You've taken a huge amount of risk out of your portfolio. Therefore, if you were willing to earn 7 or 8 bips on a round turn over 5 or 6 times a day, but with all that legging risk baked in and the chance of getting stuck with toxic positions, under Crowdfill's regime, you can turn your book over 40 times and earn 3 bips. It's a volume play versus a single shot. So done correctly, the market is going to be benefited hugely by this.
So it's product agnostic at the same time. It therefore, and indeed, Romina is on a roll today. Romina Farrugia, she's pointing out it's more liquidity and greater cash flow available. Absolutely, it's reducing between bid and offer. It's doing great things. Thank you very much, Romina. So therefore, it's product agnostic. It's very good for essentially wholesale investor portfolios, and therefore that's got to be a fabulous thing for end user investors because it means more money in our pension fund, right?
Correct, and it's a phenomenal risk mitigation tool. And one of the greatest chunks of interest we've had in the product is actually not even sort of a market-based approach, but a bunch of big banks have asked, can we use this to optimize our central risk book rebalancing? Because it's cross-asset, it's factor-based. It doesn't have to be, one single participant. So if you're looking across the span of your internal and external books, and then managing your own prop risk with your reg capital constraints, it's a phenomenal application. So there are myriad applications for it. And as we well know, the hard yards of innovation is everyone can't wait to go fifth, right? So making sure that the first folks are the first adopters, and we've made great progress in terms of market research and talking with people who want to use it. And we were, like many, we're sidelined by the virus. We were kind of close to a launch announcement earlier in the first quarter of this year, and that got punted a bit because of all this disarray. But it's great appetite in the market for it. We're looking forward to launching.
Sounds very, very exciting indeed. And I wish you all the best with that. And hopefully we'll be able to see you in the near future, come back and talk about it when it's actually running and live. That would be really, really exciting. So let's move a little bit across your fascinating portfolio of interest then. So nickel mining and exploration, the mining business. How do you manage to go from BrokerTech, the first technology platform for bonds, and make that quantum leap to trying to dig up bits of nickel across the world?
Remember, all good improv is you always say yes, right? And so a lot of it always say yes. And a lot of really interesting trading is done in the commodity markets, right? And so I was drawn into that years ago. We were managing some money for a big insurance company and some others based on this brilliant new piece of kit, that analytical kit that an inventor brought to me and showed me on the whiteboard. And I'm a guy that if the math says yes, it's going to work. Now, that doesn't discount the hard yards of sales and getting people to understand it and the rest of it, but basically applied fuzzy set theory logic as an alternative to Monte Carlo pricing to adequately and accurately price spot price commodity risk, which is very different than looking at futures markets. And so I got into working with coal mining companies. I'm a proud member of the New York Coal Trade Association, a centennial member, thank you, and oil and gas companies and other mining companies who are looking at this from a standpoint of, here's a brand new way to find interest-aligned, risk-aligned capital to help grow their businesses that was different than an offtake agreement, that was different than a pure loan, that was different than equity, but was a blend of those things, which enabled capital investors who had the appetite to bear real commodity risk, not playing around with futures contracts, which can diverge mightily from real commodity prices, as many people learned to their dismay during the heyday of the natural gas ETF craze. But we got into that. I got to know a lot of mining companies, a lot of mining executives, and began to speak with them about solutions. And it turned out to be, one of the most fertile areas I've seen in my career, and I think others have seen that, is where there are expertise from different areas, and you modify the models that are worked in one place to work in another. And the mining industry has kind of trundled along the same way for years and years and years. And I was fortunate enough to be invited to join a couple of boards and advise. I now advise one of the largest non-Chinese owned rare earth mine in South Greenland, and do a lot of work there. And so what has been fascinating to see with the nickel company, North American Nickel, is just the brilliance of those folks who focus on geophysics and exploration geology, and they're all trying to solve this incredibly fascinating puzzle, right? Of how do I determine what spot on the planet has the most stuff in it, and that I can get out for the least amount of money. And I'll shut up about nickel. I could go on forever. It's like an opera. But what's hilarious is just because people grab a hold of things, and it's easier to grab a hold of an idea. So when you say electric vehicles or distributed grid, right, and you say batteries, everyone immediately thinks lithium, and I got to go invest in lithium. Well, there would be no problem. There would be no problem with lithium supply if Bolivia could get its life sorted out. For every pound of lithium that goes into electric vehicle, it can be 20 to 30 pounds of nickel. Right? So nickel is what makes it drive farther and farther and longer and keep the charge longer. So for a world that wants to decarbonize, and a world that looks for distributed energy, a world that is yearning towards electrification, nickel is massively important. And last thing I'll say, the thing that's most fascinating about it to me is you can find a relatively small gold mine, right? If the ore is rich enough and the life of mine is 4 years, it's probably worth it if it's shallow enough. But there are no small nickel mines. It's all massive. So it's kind of fascinating. You could hide the existence of a platinum mine. You can hide the existence of lots of kinds of mines, but you cannot hide breaking ground on a nickel mine. So there's kind of wildly clear transparency globally as to how much nickel there is, how much is in the ground, how much is coming online, how much is being worn off every year. And so it's got all the very exciting dynamics of a really, really interesting market. Fascinating,
really, really fascinating. So tell us a little bit about how you see that nickel market developing then, because it's going to be an essential part of the future of battery technology, etc.
Yeah, it's always hard to predict, especially the future. But in this instance, should you believe in the growth estimates of electronification, and I don't need to get into a fight about global warming and coal, because coal's near and dear to my heart. You've got rational reasons why there's going to be a huge amount of demand for nickel, whether it's in distributed energy for more resilient grids. You can have, we all know the problem with wind is that wind is really far away from population centers for a good reason, because no one wants to live in a windy plateau, right? So a lot of the things where alternative energy those technologies are finally coming within a reasonable cost range, minus subsidies. Once you have that, the thing that makes alternative energy work really well is battery storage. So when you look at the dynamics of electric flight, electric cars, electric trucks, all that stuff, whether they're autonomous or not, it makes a lot of sense to move towards those industries. I know skeptics I respect greatly who are older than I am and have told me that at least 4 times in their 40-year career, battery technology is about to take off. Right. So I think this time the proof is more that there's there. And so if you believe all that, the demand is huge. The demand is absolutely huge. And the current supplies that we know exist, we have a good estimate of how much is there. And we also therefore know what that gap is. And over the years, you can go look at other firms that do this for a living and buy their data sets, as we have. There's just going to be a massive deficit coming in the next few years. And it's going to grow absent discovery of so much bigger deposits, which we think we've got a good idea of where they are.
And in the incestuous parish of exchanges and financial market structure, delighted to see various comments coming through. Danny Corrigan, a man who actually knows quite a lot about wind power in cities, having spent his time in developing the Astana International Exchange and Financial Centre as one of the staff there for a while. Dropping in from London to say hello to you, Chris, and also thank us very much. It's great to hear that you're watching, Danny. Thank you very much for your kind comments. Give us some suggestions, questions for Christopher, if you've got any more as we go through here. I'm interested then, you're talking a lot about the battery storage issue, all of these sorts of things as we go forward with power. Therefore, does that mean that there's going to be a huge growth in the demand for nickel going forward?
I would assume so. I mean, that's kind of what I've hung my hat on. I think there's absolutely going to be a massive upsurge. And we still have big chunks of the planet that require infrastructure development and electrification, and hopefully we're going to do that in a smarter way than we did in the past, right? I mean, one of the best things that ever came out of watching technological jumps, right, is that everyone assumed, starting I say 30 years ago, 40 years ago, that other nations were going to go through the sorts of processes on the way to economic prosperity and growth that the already developed nations had done. And so clearly copper is going to be in massive demand because all of Africa is going to put in power lines and put in phone lines and the rest of it. When everyone looked at that, there were a range of reasons for social reasons and distance and geography and infrastructure that was set up for an export economy in the 19th century versus an intracontinental economy. For all those reasons, ding, the idea went off. Well, we don't need to stretch phone lines. We just need to put up cell towers. So the demand for mobile phones, most people went right from no phone to mobile phone because you don't need to start with a landline. It's just how it developed, in the US and Europe. And similarly for where nickel is going to come into demand, both for advanced applications in US and Europe and China and elsewhere, in nations that are currently having to put in more infrastructure, the combination of solar and hydro and micro hydro and distributed nuclear with massive battery packs basically by town is going to be a huge demand. The applications are myriad. So as people are allowed to solve those problems, again, in a free way, imagine that, without anyone controlling it, the demand is going to skyrocket.
Fascinating altogether. Great question there from Ramina Faruja. She's asking, would that be the same for copper then? I think you've actually already answered the question because clearly there is a divergence between copper, which is required a lot for the sort of wires that people used to build before they went wireless or got fiber.
I wouldn't want to opine on a market I know little about. Haven't spent as much time on it. I love copper for its the shininess in the sun when you put it on a roof, and it's phenomenal for its antimicrobial properties. So I would say if every hospital in the world started putting copper doorknobs in and copper handles and everything, because anything that goes onto copper dies rather rapidly. Who knows? Maybe this is the virus that changes the architecture of millions of hospital buildings and doctors' offices around the world. So maybe that's the copper.
Very, very interesting. And actually, a couple of years back, I had the joy of going to speak at a conference in Minas Gerais in Brazil. And that's, of course, the epicenter of their copper mining business. And it's quite incredible because you could see two things in town. One was that where they cut into the soil, it just basically came out copper colored. The second thing was that the city itself had the most amazing architecture because you could tell when the price of copper had been high, because every time that it was a great bull market in copper, you ended up with, they were building high multiple story buildings. They were getting in the best architects and designers of the era. And then suddenly copper would go back into a slump and you wouldn't have quite such a fabulous fabulous tome or ode to design across the architecture of the city. Fascinating time. So the commodity market still looms large. Christopher, we're coming towards the end of our hour. We've got 10 minutes left in this 1 hour slot. Give me a couple of thoughts about where you see the world going at the juncture between your physical commodity experience and also, of course, fintech and financial markets.
My biggest concern, which I think is shared, is if we have, I don't want to label them because that's useless. If we have political urges that gather enough momentum that give voice to the certainly disproven belief that underpins a lot of Marxist thought, that there is some great overseer that can control things better than billions of people making imperfect decisions on their own. That worries me enormously, because when you have any constriction of markets from anyone that knows better, it just causes pain and suffering on a gargantuan scale. And that I find very disruptive. The places where people are allowed to trade freely in well-regulated markets, right? The free-for-all that existed in the 1910s in the United States was we outlawed most of those things, right? Just like you're not allowed to paint the tape today. Like there are lots of things that are manipulative and illegal, but if you allow people to exchange information freely and you allow for the possibility that some people are going to get it faster than others, and that's not a crime. We touched on this a few days ago, right? I mean, a lot of the screaming and yelling about high-speed trading and the supposed disadvantage that puts people to. And they were saying the same thing when Baron Rothschild set up passenger pigeons between London and Paris, and he got the data faster, right? So whether it's a transcontinental fiber line or it's a pigeon, if you invest the money to find something out faster, you should be rewarded for that. And that kind of cumulative effect of lots and lots of people being able to make free decisions is crucial, and where that ties in enormously to the commodity markets, right? We've all heard about the export commodity curse, where you typically a country that did not have a lot of money suddenly discovers they have a phenomenal resource underlying it. Managed properly, that could be the greatest thing ever in terms of creating jobs in a functioning society, and communal wealth and health and welfare, and all those wonderful things. Mismanaged, either through what I think is a diminishing bogeyman of the evil corporate rapacious predator that comes in and strips away all the value. I don't think in today's day and age, with the internet and camera phones, I don't think that's even possible anymore. The flip side to that is an overly restrictive, paranoid government that decides, we're going to tax this thing until it stops moving because it's our patrimony, it's our wealth. Well, in theory, but someone's got to dig it out of the ground, right? So as people find a balance, what we always hope for is that free discussion between capital investors saying this is what we require to take a risk in your country, and the very responsible politicians and regulators and bureaucrats and citizens of those host countries that happen to have this great mineral deposit working together and having an honest discussion about where that balance is. And we get all that balance and we get it freely agreed to, we're going to have a lot of prosperity.
On that point, an ode to the benefits of capitalism and prosperity for all. And indeed, as you said the other day, Christopher, capital markets are the solution to all humanity's problems was one of your mottos. And I think it's very interesting as we've gone through this amazing discussion from improv to elsewhere. And indeed, as I move on to the end papers today, it's fascinating to note that rising once again is the concept that the European Union is looking at resurrecting the Tobin tax. That's the tax on transactions. But of course, the problem there is, once again, we're looking at this stream of government effectively trying to overspend money that it doesn't have. As Mrs. Thatcher famously said, sooner or later, the problem with government is you're always going to run out of other people's money. That equally, though, is, I suppose, a big factor in terms of trying to enable as many of these consumers as possible. And as you said, you're not going to impoverish yourself to health, which I think is a beautiful axiom for today's discussion. And indeed, moreover, very, very interesting to look at some of the topics you've been talking about in relation to yield curve control and allowing us to actually see a healthy economic environment. I'm deeply concerned about what happens when this generation of interest rate traders suddenly see a Federal Reserve rate of about 4 or 5%. I think they're going to have the heebie-jeebies because they're simply not used to even something that's in triple basis points positive in terms of that. And thus, of course, a career defined as you defined it yourself by improv. The whole point of whatever you're asked, you've got to say yes, and you've got to move forward in terms of trying to do whatever's given to you. Remarkable resilience built into a system. Christopher Messina, it's been an absolute joy to have you today as our guest on this IPO VID live stream number 2. We've discussed everything from AI fintech, the fascinating world of Crowdfill, your current venture, to nickel mining, where you're deeply involved in many different areas, and also touched upon cryptocurrency and much else besides. But of course, a special place on our heart remains for that incredible impediment to fiscal progress, the paper check. So beloved of certain weirdly analogous states, whether it's Malta. Now, Maltese checks, try and cash one of those in America. At least with an American check, you've got a chance you can cash that in Malta if you're willing to wait about 6 months and give up most of the money that was actually in the check. Fascinating discussion altogether. Thank you very, very much to our guest today, Christopher Messina. This has been IPO Edition 2. For more of myself, if you're looking for a little bit of something to tide you over until next week, a couple of excerpts. I was delighted to join the City AM podcast. City AM is the newsletter, the newspaper of the City of London. It's currently not in print, but the website, cityam.com, is buzzing. It's going to return in September as the hordes return to the City of London after lockdown and the summer holidays. I was delighted to have joined in the footsteps of other illustrious parishioners in the world of exchanges, markets, and financial market structure, such as Michael Spencer, who we were discussing earlier, and also Billy Holt, the local boss in Europe of the TradeWeb business, discussing various matters of parish interest with this unique newspaper. You can find that at the City AM website. Equally, apart from their discussion, what's the new future of finance with myself? Google Finance Malta, you've got a brief video there. Fintech is rising, 1 minute of PLY, riffing on the topic of dear old Emma, the baby who starred in last week's discussion about the world of, well, financial markets, indeed, during this incredible time of flukenomics. Elsewhere, a final word of thanks on other excerpts. Thank you to Takatoshi Shibayama. It was a joy to join for a chat from historical Valletta to bustling Singapore recently on an episode of his Future Design podcast, which was released the other week, and you can also find it on dear old YouTube. Myself discussing financial centers, fintech, Michelin star takeaways, and much, much more. Ladies and gentlemen, my name is Patrick L. Young. Join me every day in the Exchange Invest newsletter if that's the sort of thing that floats your boat, understanding better the world of financial market infrastructure. Equally, if you're looking at the world of fintech going forward, don't forget my current book, Victory or Death, available by Amazon and all other major bookshops. And of course, a podcast. We have the Exchange Invest Weekly, which will be out on Saturday, discussing a brief review of what's been going on in the world's market structure. This, however, product, IPO VID, remains a rather broader-based discussion of everything from the yield curve to improve and avoiding impoverishing yourself in every possible respect. Thank you again to our excellent first guest in this series. Christopher Messina, it's been a joy. Thank you very much.
Great.
Correspondent, Danny Corrigan, it's been a joy. Christopher, a final word?
I've been absolutely honored and delighted. This is a gold star in a fun career. I'm delighted that I could be your inaugural guest. Thanks a lot for having me on.
Thank you very, very much, Christopher Messina. Been absolutely fantastic to have you on the show as our first guest today. We're going to be back, different day next week, Tuesday, same time, 6 p.m. London, 1 o'clock in the Eastern Standard Time Zone. All I've got to say finally is thank you to the Exchange Invest production team and the production team for this video. Beata and Ola, you've done magnificent work today. Final thanks to our guest, Christopher Messina. My name is Patrick L. Young, signing off from our second EI live stream from AI, fintech, to nickel mining with Christopher Messina. My name is Patrick L. Young. Have a great week in markets. Thanks for listening and watching to this live stream on LinkedIn and indeed YouTube.